Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Welcome back to another episode of the Real Estate Investing Club, and Happy New Year's, everybody. We are recording this on the 3rd of January. So New Year's just passed a couple days ago. It's 2025. 25 is not really a round number, but it's a nice number in my mind. So this is going to be a great year just because of that. I hope you guys are starting it off really well. We are starting it off with a bang here on the show because we have Thomas McPherson with us. Thomas is from Lucrum, and they do sustainable real estate development. He has a lot of experience on the development side, specifically in sustainable development with mixed-use multifamily. A lot of experience to go into, so I'm sure this is going to be a good episode. Thomas, I'm excited to jump into this. Thanks for hopping on the show.
Gabe, thanks so much. Looking forward to talking.
Absolutely. I told you before we got on here, we always like starting with stories on the podcast. We like to hear how people got to where they are. It sounds like you have a good one. So why don't you take us to the beginning of your story in real estate and tell us how you got here?
Yeah, really, I have to go just 5 years before my start in real estate. I was in the military, so I specialized in combat medicine for 5 years while I was in the military. When I got out at the very end of my career, I did a little investing in the stock market, and this was kind of late 2008. And what happened was I made a ton of money, and then I very promptly lost even more money, right?
That's always fun.
Yeah. It was a great learning lesson to go broke at 23, much better than going broke later in life. So I decided I wanted to get into something that I can more directly influence the outcome. Whereas when you invest in Wall Street, that money kind of goes into a black hole, and you hope that those people are good stewards of your money. With real estate, you can pick the property, you can choose to improve the property, increase rents, and do all those different things in real estate. So I got started off in multifamily brokerage. I started off as a junior kind of associate at a commercial brokerage firm here in town in Phoenix, Arizona. Very quickly learned the ropes. And after a couple of years of doing it, I thought that I had enough knowledge and experience to transition to becoming a principal and actually buying the properties that I was, putting my clients into. So that's what I started doing with some of my own money. I put together little investor groups, and I started buying, a 4-unit, a 10-unit, a 20-unit property, and it just kind of took off from there. So that's how I got my start in late 2008, early 2009.
Nice, man. Yeah, I feel like a lot of people I talked to in real estate got burned in some sort of stocks. For me, it was crypto. I was doing day trading with crypto, and I just I did make a lot of money, but I also just got taken to the cleaners. And I was like, you know what? I'm done with this. I want more control. And real estate definitely provides that. It's still an investment, and yet you can create a plan and execute that plan, which is one of the reasons why I love it. So it sounds like you started as a broker, and surprisingly on the show, we don't have a lot of people who start as a broker and then get into the investment side. I don't know why that is. You feel like it would be a natural progression, but for some reason it's not. What kind of led you to decide to create your own investment fund once you had already started as a broker?
Well, somebody had told me along the way, hey, listen, if you want to learn real estate, find a job that you can learn the business and get paid to do it. And, I wasn't interested in escrow or construction or any of those other things. So, that's really what led me to multifamily. And I grew up doing a little bit of construction, growing up, kind of odds and ends and demo and some little electrical and carpentry. So I knew my way around a house or a multi-unit property. And I'd read the Kiyosaki books. I'd read some of the Think and Grow Rich and some of these different kind of books that said, hey, there was one book in particular that was very influential, and it was Investing in Duplexes, Triplexes, and Quads by Larry Loftus.
Yeah, I bought that. I read that way back when, yeah.
Yeah, what's so great is a lot of books about becoming wealthy or affluent are very conceptual in nature, which is very important. You do have to shift your mindset. But then once you've shifted the mindset, there's not as many books that I found are really great in practical step-by-step. And Larry being an attorney, he just had kind of like do A, then B, then C, then D. Just do that and you'll be okay. And I read this book and I was just kind of knocked my socks off. Again, I was a veteran, so I had the idea to use my VA home loan to qualify for my first property. And I was able to live there for free. And just from that point on, I was hooked. I was like, okay, this is great. I'm living for free. I'm creating, wealth for myself every single month that I make that mortgage payment. And I'm absolutely in love with the business.
Nice,
So
man. Are you,
yeah, now,
do you still broker? Do you still broker deals, or are you 100% focused on the development side now?
100% focused on the development and our lending activities.
Nice.
Yeah.
Speaking of the development, so you got started, you started opening a fund, you were buying these small multifamilies. Eventually you decided to shift focus and get into development, like we mentioned, to ground up. And it sounds like you guys focus on sustainable development. How did that transition work, and why did you decide to focus on sustainable development? And actually, why don't you start with what makes a development sustainable? Like what qualifies it as being sustainable?
Great. Look, I think there's a lot. I'm so glad you asked that clarifier, because I think there's a lot of greenwashing that goes on in the industry. Really being a sustainable development, I think, is kind of the leading edge of development, because what that means is you're being a good steward of our natural resources, right? Both material resources and energy resources. You're creating a built environment that fosters the health of the occupant, that creates connection among the occupants as well as the people that are outside those buildings, and you're doing so in a way that can actually drive economic incentive for the owners of the building. So this can range from a variety of things to using non-toxic chemicals in the construction of the project, right? A lot of people don't realize spray foam insulation, although it's got a great insulative factor, it's also very flammable and highly toxic, right? Some of the carpets that we're putting in, the glues, are very, very toxic. So there's different ways that you can develop projects that are very energy efficient. You can have buildings that we have. I think our most recent one that just finished, Eco Phoenix, 80% of the energy consumed by the project is produced by the rooftop solar array. So there's several different kind of metrics there, ranging again from energy usage, material resource usage. The amount of natural ambient light in a building that comes into the space directly it impacts the health of the occupant. So it depends on what you're optimizing for, but what we're really going for is a project that's economically viable, that's a good steward of our natural resources, and creates more higher quality of life for both the occupants, as well as creating more biodiversity in the areas that we're in. Our last big project, again, it was a parking lot when we bought it, and now there's over 25 different species of plants on the project. And that is leading to benefits for pollinators and birds and butterflies and other amazing things like that. So,
yeah,
a little bit about what sustainable development is.
Yeah.
Why do I think that this is an amazing opportunity? Energy, 40%. Let me back up just a little bit. Buildings consume 40% of our energy worldwide, right? It's the single largest consumer of energy on the globe, is the built environment. So I think that if we can get much better at designing buildings that, again, consume less energy and are focused on the health of the occupant and kind of the surrounding environment, the biodiversity, we're going to create a healthier, happier, more resource independent future for all of us here, not only in America, but around the world. And I think it's an amazing opportunity that folks should be leaning into.
Yeah. Yeah. And I am always, I'm a big believer of sustainability and the kind of, I know this is a pejorative, but the tree hugger aspect of I don't mean that negatively. I just couldn't come up with a better word in the moment. But when it comes to real estate, when it comes to doing a project, it does come down to the numbers. That is always, if you're bringing in investors, it has to create a return, or else even if it benefits the environment, if there's not a return, there's no reason for the investors to put their money into it. So what is and I don't mean to, denigrate the environmental impact that you guys are making, but what is the incentive for the investors to invest in an eco-friendly project versus one that is just, your run-of-the-mill 100-unit multifamily project that just needs to be renovated? Why would they choose to invest from the perspective of their ROI, of their return? Are there government subsidies? Is there a specific benefit to going this extra mile? Just kind of run us through that.
Absolutely. There are a couple of different financial benefits. Number one, whenever you do certain energy related projects, you get a tax credit. Typically that's around 30%, right? So the solar array that we put on the last project, it was $1 million system. We got a $300,000 tax credit for that solar array. There's other energy efficiency measures that you can put into place that you do get tax credits for.
Okay, so, I'm going to pause you on that one. So solar, this is an interesting, I'm always curious about why investors choose to put solar in their projects. Cause I'm in mobile home RV parks, specifically in Texas, and Texas is their their electrical costs are just through the roof. I don't know why they decided to make their own system. It's ridiculous. They should be on the same system as everyone else because they're just paying out the ass for the electricity. So I've run numbers for putting solar panels on the RV parks, on the mobile home parks, or mostly the RV to reduce the burden on the owner. And it never pencils. The cost of putting a solar panel on, or enough solar panels to cover the electrical cost, I can't make it pencil any way that any way that I look at it, it just never pencils. How do you make it work for you to justify putting solar panels on your projects?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Yep. So I love this one. Our most recent project that finished, what we did is we actually master metered that property. And when we master metered it, we sub-metered it at the individual tenant level. When we master metered it, when we connected to the utility, that allowed us to qualify for net metering, meaning a lot of folks don't understand net metering, meaning if we produce, let's say 100 kilowatt hours during the day, and then we consume 100 kilowatt hours at night, our bill will be $0 at the end of that day or at the end of that month. So because we're net metering, we're effectively using the grid as our battery through that utility company. So number one, we don't have the cost of battery backups. We're not buying at retail and selling back at wholesale, which is oftentimes the case with a lot of utility companies. Number two, we've got about a 5-year payback because there was a 30% tax credit right out of the gate. That $1 million system now, we only have to generate enough revenue to cover that $700,000 true cost of the system. So there was about a 5-year payback. We're looking at a 17, 18% return on that investment from cash flow. And then subsequently, that system is generating a pretty substantial offset in revenue for us, or maybe said slightly different, we're able to generate higher rents because our tenants don't have a utility bill effectively. Now, when you put that on a cap rate, right, this is a brand new building. If we sell that building at, let's say, a 5 cap, that $1 million system, I can actually drive to the bottom line about another $125,000 to $150,000 of NOI directly to the bottom line. And when you put that on a 5 cap, it's much better than the $1 million it cost me to install the system. So economically, it can be a great incentive.
Yeah. No, that makes sense. And so it sounds like the net metering thing that you're talking about, that is the difference. And I'm not sure I quite understand that. So you're generating electricity during the day because the sun's out, obviously.
Right.
And so you're not using all of that. And so you're pushing the excess energy to the system and you're getting a credit for that. Is that how that works? Or to the grid.
To the grid.
Yeah.
Yeah, to the utility provider. So, a lot of utility providers initially, when solar was becoming kind of big in the mid 2015 kind of time frame, they were setting up net metering programs, which means, at the end of the month, if you consumed 100 kilowatt hours and you produced 100 kilowatt hours, you would only have kind of your interconnection fee in your charge for having a meter, 20, $30, that would be your bill. However, utility providers started to realize, oh man, this isn't working out so well for us. During the day, we're producing enormous amounts of energy. We're having to turn down our peaker plants and turn off some of our different, facilities here to accommodate this extra production from solar. We're going to start buying the solar from these producers at wholesale rates, which can literally be 2 cents, 3 cents a kilowatt hour. But then when we sell back energy to these people that are producing, we're going to sell it back to them at retail, which could be 13, 14, 15 cents per kilowatt hour. So, they very quickly realized, hey, we need to change this model up so that they're getting that arbitrage. In a lot of jurisdictions, if you have a commercial property and you choose to net meter a commercial property, you can still get, or you still qualify for the net metering. Most utilities have changed the residential metering structure to no longer be net metering. They're charging maybe a $50 a month interconnection fee for solar or something like that, or they're buying back at wholesale and selling at retail. So what's going on now in our markets here on the residential side is what makes the most sense is what we call demand peak shaving. So you get a relatively small battery system. During the day, you push all of the energy that you're producing into the house itself. Any excess you then push into the battery system. And most utilities work on, again, a peak usage demand charge. So they measure your energy usage every 15 minutes. And if it's at a certain tier, whatever that tier is, there's different thresholds. You get priced all of your energy usage in that month at that tier. And so what you can do is using a battery backup system, because you typically consume the most in the late afternoon when it's the hottest and when you come home from work, is if you can turn on the battery system and keep it in that lower tier, all of your energy for that entire month now is in that lower tier system. So all you have to do is install an appropriately sized battery system to get you through like the 3 o'clock hour to the 7 o'clock hour in the late afternoon, early evening. So that's how it still is continuing to make economic sense.
Interesting. This episode will be called Solar Panels 101. This is a good amount of information. It sounds like you've definitely gone through it, deciding to put those on your property. So I derailed us there for a second. You were talking about what are the economic benefits of doing eco development. Obviously, solar is one of them. It sounds like you guys have really nailed that down. There was also the tax credit that you mentioned. Was there any other aspect there?
There are. So the GSEs, Fannie, Freddie, they offer lower mortgage insurance premiums and expedited processing. So for big multifamily owners, you get a reduction in that mortgage insurance premium that's pretty substantial. I believe it's 25 bips, but I would have to go back and just double check that number. So there's another little benefit with the expedited processing. Time is money, as well as the reduced MIP premiums there. Also, demographics are an interesting way to bucket people, right? You and I are both men. We're probably, middle-aged men, 30s, 40s. Therefore, according to demographics, we would have nearly everything in common, right? Because of those couple little unique aspects of us. When in fact, we could have virtually nothing in common, right? Other than our love for real estate. A better way, in my opinion, to bucket people or to group them is by values, by their values of life, right? And so we use the term, it's value graphics, right? And so what happens is when someone moves into one of our buildings, they find that it aligns with their values, right? They want to live in a healthy environment, right? Because what's more important than your health? Quite literally nothing, in my opinion. Quite literally nothing. Your health and your family's health, okay? So they find that they're living in a building that's aligned with their values about their health, that's aligned with their values about taking care of the environment and being a good steward of our natural resources. Then what happens is they bump into their neighbor. Hey, what are you doing this weekend? Hey, we're going for a hike, or we're going to the farmer's market, or we're going to do something that is often exactly in line with what I would want to do. Even though they might be 30 years older than me, they might be a different sex, they might be a different ethnicity or kind of background there. Our values overline, and so you get this amazing sense of community. Why do I mention all of this? My project in downtown Mesa, we are getting the highest rents in the market. Our retention rates are half that of all of the other comparable properties because people feel like they're living in a community. They have found their tribe. And so getting back to the economic drivers, we're getting higher rents. We've got lower turn costs because we've got better retention, and there's a higher pride of ownership. So the units are actually in better condition because the people feel like they're living with family. They want to take care of it. They're not having parties, up until 2 a.m. I've owned all kinds of different properties. And when you feel like you're living next to friends and neighbors and people that you care about and that care about you, you just go that little bit of extra mile to kind of take care of things. So there are some amazing economic benefits that people don't necessarily think about at the onset when they say, oh, you're just a bunch of tree huggers. I go, yeah, I am a tree hugger who wants to make a lot of money.
Yeah. No, and I 100% agree with that. Community is so important, and it's an underappreciated aspect of investing, creating that community. Especially for mobile home parks, we definitely look very carefully at the people we let in our communities, because if you have people that like each other and that want to be around each other, and that respect each other, then they are going to stay there longer than just a bunch of people that are just looking to party and trash the place. So it makes a lot more sense to me. You guys are investing based, you're thinking about the community based on values. People with the same values, they want to stay with each other. And so when they get in these communities, in these apartment complexes, they find people that they like, and they're like, you know what, I don't want to move, even though I'm paying higher rents, because I like the people around me. Makes a lot of sense.
The self-police, they self-regulate much better.
Yep. So you also mentioned, before we get on here, it's not just multifamily. You guys do mixed use. So you guys have retail on the bottom. Give me a little perspective on why mixed use. Why not just straight up multifamily?
Well, most of the projects that we've done lately have been in urban cores. So, you really get that urban environment with these, 7-story buildings. And it doesn't, nobody really wants to live on the ground floor of a busy urban environment, right? It's just kind of not what that flavor is. So to engage that space, make it more, active, make it more engaging for not only our occupants, but then the community in general. Our most recent one, what we did is these little kind of like micro suites, these little, we call them bodegas. They're only 290 square feet. One of, we've got a baker that's going into one of them. They bake bread off site. They bring it in the morning, and then as soon as they sell out, that's it. They close up shop, So it's a great way to have these very affordable, $700 a month for some of these little micro spaces, which from my standpoint, the dollars per square foot makes a ton of sense. And from their standpoint, it's a very nominal cost to allow them to have a presence in a bunch of different markets. So we like that it engages that space, that ground floor space, and it provides amenities effectively for our tenants. If you want to go downstairs and get some ice cream or get some fresh baked bread, you can do so instead of getting in your car and having to drive to the grocery store.
Nice. Yeah, that makes a lot of sense. I haven't seen that here in the Seattle area. Smaller commercial units intended to reduce the cost for the actual business owner. But I like the idea, especially for people who can, do a ghost kitchen and then bring everything in to sell it. Makes a lot of sense.
And what else is great about that? Sorry, just real quick. What else is great is we've got a lot of folks that have contacted us. They said, hey, I'm thinking about starting a business. I can't afford $2,000 or $3,000 in rent, but I can afford $700. This makes sense for me. So it's kind of like a little incubator as well, and can really be an affordable option for people to have a legitimate business address, a presence, in their community to help them build their businesses, which is really fun for us.
Yeah. And I'm sure it works a lot for, lawyers, accountants, stuff like that as well, who just really need a desk for people to come and sit at.
Yep.
Awesome. So before we move on, you did mention you have a fund. I always like talking with people who started a fund, because I've talked to a number of people, and we've thought about building it or starting one, but I haven't actually pulled the trigger yet. But why'd you start it? Not a fund, a debt fund. So you guys are lending out your money. Why are not debt? Hard money. Is that what you said? You guys do?
Yeah,
hard money
fund. Yeah, private credit, private lending, hard money. We like to say, hard money with a soft touch. One of our taglines here. I'll go back a little bit in time. 2008, 9, 10, right during the Great Recession, there was a lot of properties that were distressed. They were being sold, as an REO property, as a short sale, or at auction, at a public auction. I was bidding on behalf of clients to try and get these properties, or I was talking to the banks trying to get the listings when it went back as an REO. And I'm the kind of guy who likes to just keep swimming upstream. I don't like to compete necessarily. I mean, I love to compete, but I also don't want to compete, when I'm trying to get the best deal possible.
Yeah.
And so what I wound up doing is, as a broker trying to get these listings, I had one bank portfolio manager that said, hey, listen, man, this REO listing, if we get this property REO, you're not going to get the listing. But if you have a client that wants to buy the loan, I'll sell the loan. And I thought, ooh, okay. Yeah, let me see if I can find a client to buy that loan. And I did. What happened was, long story short, the client bought this loan. It was a $450,000 loan. The property was probably worth $400,000 to $450,000. He paid $250,000 for the loan. There was a chiropractor that was in the building before he'd even closed on the loan, called the chiropractor that was in the building and said, and he owned the building, and said, listen, if you can refinance me out, I will accept $350,000. So that's a $100,000 discount to what you owe. The chiropractor was thrilled. This was done in 60 days. My client made $100,000 on a $250,000 investment in 60 days.
Damn.
From that point on, I was hooked. So I dove into kind of the distressed debt space, and I did that for about 5 years. I made a ton of money for myself and for my clients. Fast forward to more kind of modern, I started a private credit fund in 2019, 2020 that was going after these distressed debt, right? I thought, hey, it's been a 10-year bull run. I think we're due for an economic downturn. COVID happens. I literally think I'm a genius. I think that, I'm going to make $1 billion because I've got perfect timing. And then, of course, the market just absolutely takes off because the Federal Reserve and government was throwing trillions of dollars, out the window. Yeah. So I decided, you know what, I'm going to get out of the distressed debt space. It's a very adversarial space. You're constantly kind of fighting. I want to get into the more collaborative space of originating performing debt. It's a good place for me and for my money. And it's a great place to build consistent, predictable income, right? You can't live off of appreciation. Appreciation and growth are great for building wealth. However, you have to live on cash flow. So as a portion of my portfolio, I've put $3.5 million in my fund. And that generates, about $30,000 a month for me to live on, for me, my wife, and my kids. It's great because that money comes in like clockwork every month. So I love private lending. I think we're providing a ton of value in the investment space because we're actually helping with not only the affordability and lack of housing supply in our marketplace, because banks just take too long. The Dodd-Frank Act really tied banks' hands. And, you can be a real estate investor like you and I. You can make $1 million this year, but because of depreciation and other tax benefits, on paper, I made nothing, right? And so a bank will say, sorry, I can't lend you any money. You didn't make anything. I go, but I literally made $1 million.
Dude, I got it in the bank right now. What are you talking about?
I own this property free and clear. Can't you refinance me? And they go, no, you don't make any money. Your debt to income ratio doesn't work. And I'm like, this is bananas. So I don't want to get off the topic, but yeah, banks can really drive me crazy sometimes. It's like, can you guys think out of the box just a little bit? Just like, I get that they have their rules, but yeah, anyways, makes a lot of sense. The rules for, the instructions for how to get outside of the box are unfortunately outside of the box.
Right. So you started your debt fund. And what was it like? What was the process like? Are you only focused on single family flips? Because that's traditionally when people do hard money loans, they focus on the flippers. Or are you doing commercial? What does it look like?
We do commercial. We do single family flips. That's the bulk of our portfolio because, quite frankly, that's just the largest transactional volume in our marketplace right now. But we also make commercial loans. I've got, again, a strong experience in commercial. I've owned office, industrial, retail. I've done ground up multifamily development, mixed use development. So we do make commercial loans. But again, the bulk of our portfolio is that single family flipper or that ground up construction, that single family kind of new build construction. Then that's where we really shine. We can get a loan done in a week, whereas a bank will take 60 days or more if they get it done. I almost feel like it's like guilty until proven innocent. Like with a bank, like they want to find a reason to say no. Oh, that appraisal didn't come in high enough, or your taxes aren't quite good enough. Instead of, we fundamentally start with yes. And if someone gives us a loan request and we just can't quite get there, we go, well, we can't get there, but what we can do is right here.
Yeah. And it's really hard on the commercial side, especially for like mobile home RV parks. A lot of them are mom and pop owners. And so they just, they're not using QuickBooks. They don't have these P&Ls for 3 years that you guys want to see. A lot of times their personal tax returns are meshed up with their business tax returns, and it's just mess. And so when you bring this to a bank, the bank's like, oh, we can't lend on this. I just closed on a deal a month and a half ago down in Texas. It was a slam dunk. I was like, this is guaranteed to get a lender. Couldn't find anybody. I called like 40 banks. Eventually somebody decided to lend on it, but it took 60 days to get it done. And I just had to hound them. But yeah, being able to go to a private lender who can see it for what it is, can think outside the box a little bit, see the potential, really makes a difference. So it makes sense that you guys want to provide that service, and it's a benefit to everybody out there who's looking for those people who will lend on products that traditional banks do not like. We have gone through the time. In fact, we've gone way through the time, but that's fine. Sometimes we go a little long. I'm going to push us into the quick question round, though. You ready?
Let's do it.
All right. Starts with books or any form of education. Could be a conference you've gone to, book you've read, movie you've seen. I need 2 recommendations, one for general life wisdom and one for real estate.
A recent favorite has been Marcus Aurelius' Meditation. It's just great for dealing with the adversity and challenges that life throws at you. Yeah. So that would be my generalization. And I mentioned it earlier, but for those folks that are interested in getting into multifamily, Larry Loftus's Investing in Duplexes, Triplexes, and Quadruplexes was a fantastic technical book on what to do once you've gotten to the point mentally where you're ready to go. This book is a great tactical book that just tells you how to execute and just keep leaning into learning once you put those strategies and tactical things into place.
Nice. Yeah. Meditations is actually my gift book. Whenever I gift books to people, that's my favorite one to do. It's great. I call it the toilet book because it's in little snippets. You can sit on the toilet, read a few of them and put it down. It's a really good book. All right. Next question is for your younger self. Let's go back to the Thomas who was just getting started so many years ago, back in 2008, I believe you said.
Yep.
Go back to him, look him in the eye, give him one piece of advice moving forward.
Don't sell anything. No, there's a bit of a balance there. And obviously we've got the benefit of hindsight, right? I was pretty aggressive. So, I think a lot of folks would probably say to their younger self, hey, be more aggressive. You can afford to lose money now. You don't want to lose money when you're 60, right? You can afford to lose money now because you can build it back. Fortunately, I was pretty aggressive. Now that I've built a substantial net worth and I've got wife and kids and a family, I've definitely kind of toned back the aggressive investing. But I would say, be aggressive and do your best not to sell. Even though you can take advantage of 1031 tax exchanges, just refinance. When you've done the hard work of finding a great property and then you've fixed it up and you've done all that heavy lift, just keep it, refinance it, take that money back out, and then dive into another new project. Now, of course, you don't want to own bad properties. You don't want to own, headaches, but for your better located properties, just continue to own them, man. Don't sell them.
Yeah, that's a hard one. I even struggle with that today, is the not selling aspect, because it really takes a long-term mentality. And sometimes you get into positions where you're like, I need that capital. These projects I want to do, and you want to pull the trigger. You want to sell those properties with a lot of equity in them. But I like that piece of advice because I feel like in the long run, it is the correct way to go about things. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what is your favorite way to generate leads and find new deals?
A couple of different things that I'll say. Driving the neighborhoods that I want to own in is like the easiest. I mean, it is so basic to just drive streets in your neighborhood and you go, that property looks kind of run down. You write down the address, you snap a photo, and then you look up who the owner is. Or even go knock on the door. Just take the next step and go knock right there on the door. And I have generated literally millions of dollars in revenue and profit from doing just that one thing. So that's a real kind of basic one there. And then, of course, there's the networking and the meetups, and activity begets activity. But honestly, the easiest and most basic one is driving neighborhoods, because then inevitably what winds up happening is, you see properties being built and you see a GC on site and you see someone kind of in a nicer car dressed kind of nice. And you just walk up and introduce yourself, especially as a young investor. Hey, I'm a young real estate investor. Is this your project? Is this your house? Is this, your new build? Can I take you out to coffee and learn? And then you're out there meeting the movers and shakers. So, STP, see the people, see the properties. Those are kind of the two things that I think you have to live by in real estate.
Nice. Driving for dollars is a great way to do that. There was an app that somebody recommended. I forgot what it was, but I meant to write that down so I could keep recommending that to people. It's the one. I guess there's an app out there. You can just take a picture of a property as you drive by it and send a letter from the app.
Cool.
I don't remember what it's called though. I'll remember it and give you guys that later. Next question is about lessons learned. Not every deal goes the way we expect it. In fact, many times things go wrong and we get to learn a lesson. So what was a deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
Number one, always have a contingency. Always, always, always. I've read, earlier on, I was mentioning I was hyper aggressive and I tried to be fully invested in every single deal because the money in my bank account was money not making me a good return. Right. So I tried to be fully invested. With that said, I would still say, to my younger self, hey, man, I totally get it. You're trying to grow and build fast, but just have a little bit of money carved out for contingency, because I promise you, if you keep doing this long enough, something will happen. I promise. I promise. The other one that I would say to myself is, don't partner with people just because you like them. I've had business partners, project partners, business partners, and we were partners because maybe we were friends, or we were young folks kind of coming up in the business. Find people that are as ambitious as you, that can provide value to your partnership, right? And so just being hyper aware of who you decide to kind of, quote unquote, financially speaking, get in bed with. That can be one of the most draining things when you're in a bad partnership or a bad deal. And I've had to have deals where it goes sideways and I say, hey, listen, man, this isn't working out. Either you buy me out or I'll buy you out. But let's just kind of part ways early, amicably, before this really deteriorates. And fortunately, I've been able to see some partnerships that have started to fray. And I said, okay, before this gets really ugly, I'm just going to, head this off at the pass. So,
yeah.
As a young person, you want to partner kind of with anybody that you think might be able to help you grow, but being really selective, you really need to think about a partnership, a financial partnership, as a marriage of sorts.
Yeah. Partnerships are, they're difficult. They are. I am a big proponent of partnerships. I've had people on that say, don't ever partner on deals. I think it just makes it more fun. It makes it more enjoyable to do do the investing. But two, it also allows you to focus on your own skills and allows somebody else to focus on their own skills, which makes the whole bigger. But it's also, like you said, it's very, you have to go into it with eyes wide open, and it has to be a good partnership. And I like that you said, don't partner just because you like people, because I feel like that is good advice. It can't just be based on your feelings toward a person. It has to be based on what is actually happening in the deal. Like if you guys are both acquisitions people and you guys are both finding deals, then there's nobody that's going out there talking to investors. There's nobody that's doing asset management, doing construction management.
Yep.
That you guys have to have complementary skills. You can't have the same skills. And I feel like it's really good advice. Not a lot of people say that when I ask this question, but I feel like it's good advice for anybody, really.
Absolutely.
And that pushes us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure if people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Perfect. So you can find me, my company, Lucrum, Lukrom, Lucrum.com. You can contact us and you can reach out to us. And one of my favorite things is, number one, we offer investments in the real estate space, both in equity as well as the private credit space. I love mentoring other young folks that are coming up in the biz. I typically am happy to carve out 30 minutes of my time periodically to just talk with young folks and try and give of my wisdom, because it takes very little of my time and of my energy to give to folks, and it can be transformational for some of these people that I'm able to share my wisdom and keep folks fired up. And the last little kind of piece that was an unsolicited question, but something I'm going to say is, you can make money in any real estate environment. If it's going up, if it's going down, if it's going sideways, it doesn't matter. There's money to be made. There is no better day to start investing than today. So get started. That is the most important thing. Do it. Do it. Do it. Just get started. Do it.
Perfect. I will. We'll leave it with that. That is the perfect piece of advice to drop this off with. So for everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.